This is BullionMax. We're going to take a look at precious metals as collectibles, as an investment, as a hedge against inflation. My co-host is Sean Reynolds. He's the customer service manager for BullionMax. Our guest today is the contrarian. We're just going to cut right to the chase, David.
Get that out there.
You get it out there. David Hunter, his newsletter is the Contrarian Value Advisor. Let's start with your background, David. What led you to become a contrarian?
Yeah, I've been in the business. I would start out back in 1973. I went right out of college into a bank investment department. It's what I always wanted to do. I studied finance in college and started out in a small bank. So I was doing both bank portfolio, which was bonds, and trust portfolios, which were more equities. Did that, got my MBA at night while I was doing that, moved on to another bank out east. I was in the Midwest then, moved out east. Had to choose. It was a bigger bank, so I chose equities as kind of my preference. But the first 4 or 5 years of my career in that small bank gave me exposure to both the bond market, the stock market, and everything else macro, and that really kind of set the stage for me. I went from banking to pension fund manager for Textron. I was their equity pension fund manager for 5 years, had top 1 percentile performance for those 5 years. Went from that to Fidelity, and then from there to the head of active equities at ITT Hartford Insurance, and then was a CIO of a $1 billion company in New York. And then my second half of my career was as a macro strategist, which is what I'm doing now. So I kind of was contrarian early on. I can't really tell you whether I knew enough in those first year or two to be a contrarian, but I developed it very quickly. I think I was naturally a value type guy and a contrarian anyway. And that's been pretty much my whole career since then. And basically it's recognizing that investor psychology is a huge part of the markets, and that when everybody else is bearish, that's already reflected in the market. That's probably a good time to start looking the other way. When everybody's bullish, that's reflected in the market, and it's probably time to look the other way. So that's kind of the simplistic basis for it.
Would you say that you were a contrarian when you were a kid growing up?
Yeah, I would say that. My parents would probably say that. So and I was thinking that way then. I didn't know the word, but when I look back, yeah, it was very natural for me to kind of take the other side of arguments, particularly with parents.
Don't we all?
And
Yeah, I did that. Not with very good results, though, I might add.
Oh, yeah,
I
it
feel
depends.
sorry for my parents. I'll put it that way,
But I'll tell you, that is where I got some of my best skills when speaking with customers, knowing what not to say.
Right, exactly.
Yeah.
But I would say that now it's just ingrained in me in terms of I'm happiest or most comfortable with my forecasts when nobody agrees with me. I mean, that's when I have my greatest success, is when everybody thinks I'm foolish and wrong.
Do you have some examples of that? I would love to hear an example of that when everyone was thinking one way and you went, nope, it's this, and bingo, you were right.
Yeah, I'll use the recent example, which is
great.
The precious metals. Obviously we had a nice run out of the March 2020 swoon, and they had a really nice run into August of 2020. I thought they'd probably correct for a few months, consolidate, and then run again. So for the last year plus, I've been saying gold and silver look great. They're bullish, and we were in a long consolidation instead of a short consolidation. Probably 3, 4, 5 months ago, I was getting screamed at that I was an idiot, that gold and silver could only go down from here, that gold was going to 14, 1500, that silver was probably going to 15 or lower. And I just stuck to my guns and said, no, everything I look at points to this is a high level consolidation. And when we move out of this, it's going to be a rocket ship up. So, I'm calling for $50 silver and $2,500 gold. And I've had that forecast for quite some time.
I'm curious, David. What is a macro strategist? Let's start there.
Okay, that's a good question because macro obviously is covering the markets and the economy. As a strategist, I can't recommend individual stocks. I can't recommend or advise anybody to do anything. I'm basically forecasting markets and I'm forecasting the economy. I focus mostly on U.S., although I do look at Canada and China and Europe. But my real focus is U.S. centric, and right now, gold and silver are in play. So I'm not quite as hated as I was before with my bullish call. I think people are starting to get on the bandwagon.
Helps when you're kind of right.
Yeah.
It does help.
It's amazing. I have said for a long time that investor psychology is probably the most powerful emotion in the world, more powerful than love or hate. Because it surrounds people's money, it's just amazing the power of that psychology. And people are really drawn to the tape, what I call the tape, because I started in '73, the ticker tape,
Sure.
So they're drawn to the momentum of the market and tend to go with the crowd. And when the market's going down, they can't understand, and has gone down sharply. They can't understand somebody having a view it's going to go up, and vice versa. So
you gave
they take it very personally.
Go ahead, David. I'm sorry.
I was just going to say, so they it really does cause them to take it very personally. I'm on Twitter with 160,000 followers, and I would say 90% of them are silent, but that other 10% are very loud, and they let you know what they think of you. Let's put it that way.
And we hear that on the phones as well, that that investor psychology, the concerns they have, the idea that their dollars are not going to remain dollars, they're going to get smaller, or something's going to happen to their nest egg. You're absolutely right. There's very, very strong emotion behind that.
The other thing is a macro strategist tends to be looking at longer term trends. So I'm not really concerned about what happens, next day, next week, even the next month or two. My focus is really on the trends, and trends take time to play out. And so, I did call this correction back when S&P was at 4,800. And everybody was telling me, because I've had a Meltup call since March of 2020 and before, actually, but was calling for much higher prices, and it had the high forecast on the street. So people associate me with that Meltup call. When we took off in December and headed for 4,800, I said, no, this isn't it. We've corrected once in early December again, kind of just before the Santa Claus rally, and it ran to 4,800. And people are saying, you're missing your own Meltup. You're too bearish. I said, no, I just see too many divergences. This isn't it yet. And I was told I was dead wrong at 4,800. Those same people now, and I called 4,400 as where it was heading. It went below that, but people now are telling me I'm crazy to be bullish again. It's the same people that were bullish at 4,800 are now thinking I'm wrong to be bullish. So it's, investor psychology is a powerful part of market dynamics.
Let's talk about corrections, okay? I've talked to a couple of people, and they say a correction could be 5, maybe 10, maybe even 15% on the market. What is your definition of a correction first?
That's a good question. I had that argument this morning with somebody who said the market's down 20%. You're calling it a correction. It's no longer a correction. It's a bear market. And I said, well, first of all, the Nasdaq's down 20%. The S&P and Dow are not close to 20 yet, and I don't think they're going to be down 20%. Secondly, that 20% number was an arbitrary number that I attribute to CNBC. Many years ago, they slapped that on as an easy definition to say, oh, if you're over 20, it's a bear. If it's under 20, it's a correction. It's very arbitrary. Who's to say whether there's a difference between the market being down 19% and the market being down 21%. I don't
Tomato, sure.
yeah, and it's other things that are going on that help determine whether this is a cyclical bear market or whether it's just a correction that has gone a little farther than normal. And particularly with the kind of move we had out of March 2020, where the index is more than doubled. A 20% correction is not a 20% correction in the old days. So I view what we're in as a correction. Some would tell you no, they think it's a bear market, and certainly many think if it's not a bear market yet, it's going there. But everything I look at says there's another leg to this bull market. And by the way, I call it a secular bull market that started in August of 1982. And so there are cyclical bulls within that secular and cyclical bears within that, but that's a 40-year run from August of 1982. I use that date because that's the beginning of the disinflation cycle after very high inflation in the early 80s. Yeah, I'm one of the few on Wall Street today that was investing back then. And I can tell you, what drove this huge run. We were looking at the Dow back then, so I can talk about the Dow. The Dow bottomed, I think, at 782 in August of 1982, something around there, 780, 80 or 85, and is now obviously got up to 34, 35,000. That's a huge run. And the reason we did that, many multiples of that price back then, that index back then, is because you had inflation come down from 20% to almost zero. You had interest rates come down. The 10-year came down from 15% to 0.4% in 2020. So the inverse of that is the PE multiple. The multiples move inverse to that. So we had this big multiple expansion. PE multiples in 1982 were single digits. Today they're in the 20s, or were in the 20s at the highs. So that's a big part of what this bull market has been. Obviously, earnings have expanded greatly, so that's the other part. But so that's why I date it to August of 1982. Most people think the bull market, secular bull market probably started after the 2001, 2000 top in the NASDAQ went down through a big bear market, was down almost 80% then. Or they used the 2008-9 bottom. I said, no, those were cyclical bears, but the secular bear is still ahead of us. And I think that the secular top happens this summer. And I'm calling for 6,000 on the S&P. So,
wow.
So that's why I'm controversial out there, because everybody's thinking we're going down now that we've seen the highs. And I'm saying we're not only going to higher highs, we're going to a lot higher highs in a hurry. I mean, this will be a very historic final rally. What I call a parabolic final leg to a secular bull market.
Our guest is David Hunter. He is the contrarian, if you will. His newsletter is the Contrarian Value Advisor. This is BullionMax. I'm Mark Allen, along with Sean Reynolds. And Sean, are you seeing more and more people being interested in precious metals of late?
Yes, most of the people who are calling are specifically about the investment portion of it, not really collector type of items. They're really hedging against inflation. Many of them are kind of counting on market movement like we haven't seen. You don't normally have volatility in the metals market. Things will go up and down a little bit, but otherwise we've been doing kind of the sine wave in 6-week patterns. That's done. So we're into some new territory that's not nearly as predictable based on what has just happened. But most of those people are really looking at, how do I make sure my dollars stay dollars? And how do I make sure that everything I've earned I don't lose, because the dollar itself is going to become virtually worthless.
And
So
what
that's
people
what's
can,
making the phone ring.
right, what people can do is we have our website, BullionMax.com, up throughout our conversation. And you should go and take a look around. There's a lot of information there. It's absolutely free to learn more about precious metals investing. And you can talk to Sean about what you could do, how to add precious metals to your portfolio. And we encourage you to do so right now. I wanted to get back to David. I kept writing all kinds of questions down, David. You keep firing here in my head. And I wanted to know, right now we've got this horrific problem in the Ukraine. It's already driven up gas prices. I don't understand how that works myself when we only import about 7% of Russian oil. It doesn't make sense to me that gas has gone up here in California, where I live, over $1.50 a gallon. Oil companies are making a killing once again.
Well, I would caution on that. It really is at the margin. 7% is a huge amount at the margin. Again, you take 7% away from the full amount, and we were already in a tight supply-demand situation. It makes a big difference. But frankly, the bigger difference was this administration's policies towards oil and gas when back when Biden became president. That started the whole rise in prices and created some of the tightness we had going into the Ukraine situation. So it really isn't the oil companies per se. Look around the world. Brent's moving up just like WTI is. So it's a market supply demand situation. It's short term, but it ultimately, it's going to crimp the economy for sure, because it's taken a lot out of the consumer's pocketbook.
If you're hearing a background noise here, I'm at a convention in Anaheim, California, and I'm in the press room, and so it's kind of like a free market, if you will. People are walking around behind me, in front
buzz,
of me.
to the atmosphere.
Yes, it does.
Makes it seem like there's more going on than what we've got going on between the three of us here. But
yeah,
nice little
exactly.
atmosphere.
All kinds of things. Let's take a look at the economy, David. It's been very robust for a long time. Is it going to is it robust now, and will it come back?
Yeah, it's I think decelerating, and maybe decelerating quite quickly. All the talk about tightening, and the foregone conclusion in most analysts' minds that we're going to see many hikes this year. I've been on the other side of that, saying we'll see a hike in March for sure. I think they've pretty much telegraphed that. So we'll see a quarter point from the Fed next week. I'm not so sure we'll see a lot of hikes behind that, at least for the next few months, because I think the economy was already decelerating before Russia invaded Ukraine, and this drive up in gasoline and oil prices, heating oil, etc., is really crimping the consumer's pocketbook. And you're going to see, I think, an economy that flatlines, if not worse. So the Fed initially looked and said inflation's really starting to soar here. We dragged our feet because we thought it was supply chain related. Some of it was, but some of it was also all the money that was printed, et cetera. It's demand driven, and to some extent with the wages, it's becoming a little bit driven by wage cost push. They're now taking it seriously and saying we have to tighten. The problem is, just as they decided to take it seriously, we get this Ukraine invasion and gasoline prices go through the roof. And now you're going to see the consumer, I think, back off, and you're going to see the economy decelerate into the second quarter pretty fast. That, I think, my view, and this is a contrarian view right now, but my view is that you may see a quarter point rise next week and then have the Fed sit on their hands for a couple months and watch. And it's during that where I think it'll help the stock market. In other words, and I started saying this in early January, the Wall Street narrative about tightening, not the Fed's narrative, the Wall Street narrative about tightening, I forecasted was going to reverse. So you had 6 or 7 tightenings built into the market. And my argument was that that was going to get reversed, so that you'd go down to whether it's 3 or 4 tightenings or 1 or 2. And that's what drives the market, not so much what the Fed does, but what the street expects. And so I think the economy is definitely slowing down. Now, my bigger picture view, we're cramming a lot into a short time, but my bigger picture view is that we are probably going to peak out the economy before the end of this year, and that we are heading for a global bust. A recession, it would be the normal term. I use bust to define something that I think is going to be bigger than 2008-9 and steeper, and so maybe cause some of the damage of a depression, but happen in the speed of a recession. So I've used the term global bust for a while now. Everybody else is picking up that term, but I was using that, 5, 6, 7 years ago to say when this cycle ends, it will end in a bust. The reason I use the term bust is simply because we've got 300 trillion in global debt overlaying this economy, this financial system, along with quadrillions. That's a term that I can't wrap my head around it, but quadrillions in derivative. Debt and derivatives are both forms of leverage. Debt's leverage on the economy, derivatives are leverage on markets. That will speed up and steepen any recession, any bear market. So I think we're going to see the biggest economic downturn in the post-World War II era, accompanied by potentially an 80% bear market in stocks.
Would you say that then, from what you're saying, we have a world economy?
This is global.
Right.
This is global, and it will, like I said, it's not going to be dragged out like the 30s. This is not a Great Depression. This is a bust. It will happen. Probably most of the damage will be contained within a year. So it's more similar to 2008-9 than it is the 1930s. But
So we won't have people standing on corners selling pencils and apples.
probably not pencils and apples, but we already have a homeless situation. It's only going to get worse. You are going to have a pretty big jump in unemployment and all of that. Why it will be short-lived is because you'll see what you saw in March of 2020 on steroids, meaning you will see, instead of 5 trillion of new money, probably 10 or 15 trillion of new money created. Now, again, we're throwing around trillions when we used to do millions and billions.
Mm-hmm.
So, if you have right now a $9 trillion Fed balance sheet, it's going to certainly exceed 20 trillion, and I think could get up to 30 trillion. If you go back to 2008, the Fed's balance sheet, for as long as it had existed, the high watermark for the Fed balance sheet was October of 2008 was 875 billion. We're now at 9 trillion. One cycle later, and I'm saying we could go to 30 trillion. I mean, I don't know if people, numbers get thrown out now. I don't know if people really recognize what that difference is, but that money with a lag will jumpstart a new recovery. It will also jumpstart an inflation cycle that will make what's happening right now look mild. So I forecast.
Go ahead.
I forecast by the end of this decade that we will see inflation exceed 20%. And interest rates go back to what they were in the early 1980s, meaning 20% T-bills.
Wow.
And 15% long bond. So and we will have gold at 10,000, maybe 20,000. We will have silver at $400 plus. We will have oil at $400 a barrel or higher. We will have, copper through the roof, nickel already through the roof, but you're just going to have natural gas will go up manyfold. You're going to have an inflation cycle unlike any in history. So people are calling it a commodity super cycle now. The only problem is it's not a straight line from here to there because of that bust. So commodities will take a tumble, a hard tumble during that bust, meaning basically in 2023. But coming out the other side, it will begin a super cycle that will be unlike anything we've ever seen.
We have a lot of questions and we only have a few minutes, so I'd like to invite you already back in maybe a month or so to continue the conversation and to see how your predictions have gone. Precious metals, how does that fit into your macro strategy?
I am in the camp that believes the precious metals are the most attractive asset class right now. They had, well, crypto took off, equities took off. I'm talking about from 2020 to now. Gold and silver sat in this consolidation for a year and a half. So they are really lagging behind almost every other asset class. And they're really situated better than any asset class for what's coming, both inflation wise, because, and particularly inflation wise. If you're going to have the highest inflation cycle that we've seen ever, certainly in the U.S., then these are the assets for that. That's why I have such high targets for them down the road. I think they're poised right now for the run before the bust, meaning this last 3 or 4 or 6 months before the bust. And then they're even better situated longer term for that much bigger run. Just understand that in between the two periods, with that bust in between, I use the analogy of standing on the south rim of the Grand Canyon and looking across to the north rim and thinking you can walk straight across. There's a canyon in between. Well, the global bust will be the canyon between now, this next few months, and the big run after the bust. So if you hold on to them through the bust, just know it's going to be a lot of volatility.
Will there be what's been described as a melt up, and then the bust that you're talking about?
Yes, I use, and I actually, frankly, the melt up is, everybody uses that term now. I started using that term several years ago and nobody was using it. So I think a lot of it is because I use it a lot. I do believe we are going to see an equity melt up, and I use that specifically for parabolic run into a secular top. That's a very specific definition of what a melt up is, a blow off or a melt up. People will use the melt up to define any steep rally. So if gold goes from 1800 to 2500, people say, "Oh, look at the melt up." I go, "That's not a melt up. It's a nice rally." But so equity wise, yes, there's a melt up coming in the next 3 months, 3, 4, or 5 months. But in gold and silver, I don't consider what's coming here or what started here a melt up. It's just a very nice rally. It's semantics, but it's I figure terms should have a real definition to them.
David, thank you very much for your time. Before you go, I just wanted to talk to Sean one more time. You're the customer service manager for BullionMax. Does this make sense to you? And are the people who are calling you, asking questions, visiting the website, are they looking to hedge against inflation? Are they looking to save their dollars by investing in precious metals?
Yes, nearly, excuse me, nearly everyone who I speak to these days, that's their goal. Most of them are first time investors. So I need to get them educated on how the market works and how the pricing works for precious metals items, things of that nature. And when I find out what their goals are and what they're looking to do, I'll make recommendations of product, but I will always let the client make the decision what he or she should buy for his or her portfolio. It's for them, it's not for me. I'm just kind of the facilitator to get you through the store so based on what your budget is and what your goals are, what types of products might be a good fit for you.
Got it. And of course, we invite you to visit BullionMax.com for all the information that you'll need about precious metals. David, as we wrap up, the Contrarian Value Advisor, how can people find out more about you and learn about your newsletter?
Sure, they can find me on Twitter pretty much every day. I'm there, and that's at Dave H. Contrarian. If they have interest in the newsletter, which is a quarterly letter, I purposely only write a quarterly letter because of, trends are longer term. I don't want people thinking this is a trading letter. It's not. But if they have any interest in the macro letter, they can direct message me on Twitter, and I'll provide them details. There's a cost to the subscription. It's not free, but it is, you kind of get a flavor of my views. They're not household views. So that's pretty much what you'll see in the letter as well.
And to see your Twitter feed, it's at David H. Contrarian.
At Dave H, not David.
Oh, I'm sorry.
So
yes, you're right.
At Dave H. Contrarian.
And it's right underneath me. I can't read it. It's right. Yep. It's right here. We've had it up.
I should caution people as well. For anybody that's on Twitter, they know this. I have over 100,000 followers, 160,000 followers. Unfortunately, what comes with that territory is a lot of fake accounts. People will try to copy you and get people, and some of it's through fraud. Some will try to get money from it. Say they're offering my service or something. Be very careful. It's very specific. Dave H. Contrarian. They will go Dave H. and then change one letter in Contrarian. There are about 15 or 20 fake accounts out there that have my profile picture, look like it's me, but they have a different spelling of Contrarian. That's what you have to look out for. So, be very specific about Contrarian is CONTRARIAN. So it's Dave H. Contrarian.
Got it. I was going to look it up just to make sure.
Yeah.
What was that?
As much of a pain as that is, it's a sign of success for you, though. So it's kind of a backward compliment.
Yeah, but it's troubling because people are being defrauded as a result. I get people direct messaging me and saying, "Was that you on Telegraph?" I said, "I'm not on Telegraph." Yeah. So, and somebody's trying to tell them if they pay them, in Bitcoin, they'll give them my service, and they're just trying to take advantage of people. And
we should point out that you don't advise on buys or anything like that.
Yeah, absolutely. Zero advice. It's entirely, forecast related.
David, will you come back and visit with us again?
Sure. Probably be. I'm pretty busy with these, and I try not to overload.
Sure.
People don't need to see my face every 2 days, so
we'll do it in a couple months.
Somewhere down the road, maybe in a few months, that would be fine.
All right, great. We appreciate it. Our guest, of course, David Hunter, the Contrarian, and I appreciate your time. Sean, thank you very much.
Most welcome. Happy to be here.
This is BullionMax. I'm Mark Allen. We'll see you next time. Bye-bye for now.
Thanks, Mark. Thanks, Sean.